Hello everyone, and welcome to Strategic Management of Multinational Corporations, Lecture Note 10, Corporate Strategy and Product Diversification, based on the academic courseware by Professor Shihmin Lo. While business strategy explores how to compete within an industry, corporate strategy determines where to compete, defining the scope and product boundaries of the firm. Over the next 10 to 12 minutes, we will examine Michael Porter's 3 essential tests for diversification: economies of scope across tangible, intangible, and organizational capabilities, Goold and Campbell's parenting advantage, the empirical inverted U-shaped performance curve, BCG and GE McKinsey portfolio matrices, the Ashridge Portfolio Display, shared services organizations like Procter & Gamble, and corporate control styles. Let's step into the economics of product diversification. We begin with the core motives driving product diversification: growth, risk reduction, and value creation. While 1960s conglomerates expanded for pure growth, modern financial theory notes that investors can diversify portfolio risk at far lower cost than corporate M&As. Michael Porter established 3 rigorous essential tests for diversification. First, the industry attractiveness test. Second, the cost of entry test, ensuring acquisition premiums do not devour future profits. And third, the better-off test, requiring that combining businesses creates true synergy. Failing these tests leads to the conglomerate discount, where stock markets penalize over-diversified firms. The primary economic justification for diversification is economies of scope, cost savings achieved by sharing resources across multiple product lines. Scope economies stem from tangible resources like shared distribution networks, intangible resources like brand extensions and proprietary technology, such as Fujifilm leveraging film coating technology into pharmaceuticals and cosmetics, and organizational capabilities, seen in LVMH applying luxury brand management across over 50 distinct houses. Michael Goold and Andrew Campbell introduced parenting advantage. Corporate headquarters creates value only if it adds more net value to a business unit than any rival corporate parent could. Corporate diversity spans from single and dominant businesses to related constrained firms like Johnson & Johnson, related linked firms like Amazon and Disney, and unrelated conglomerates like Berkshire Hathaway. Empirical research reveals an inverted U-shaped performance curve. Moderate related diversification maximizes synergy in the strategy sweet spot, whereas excessive diversification degrades performance due to organizational complexity and coordination costs. Prahlad and Bettis introduced dominant logic, top management's shared cognitive mindset regarding value creation, which enables successful diversification across distinct business units. Multi-business corporations rely on portfolio planning matrices to allocate capital. The Boston Consulting Group Growth Share Matrix maps units across market growth rate and relative market share into 4 quadrants: stars requiring heavy growth investment, cash cows generating surplus cash, question marks requiring strategic evaluation, and dogs targeted for harvest or divestment. The GE McKinsey 9-box matrix provides a multi-indicator assessment across industry attractiveness and business unit competitive advantage, guiding build, hold, and harvest strategies across corporate divisions. Unlike classic portfolio tools, the Ashridge Portfolio Display by Goold and Campbell evaluates parent-subsidiary fit by mapping value creation potential against value destruction risk. Units fall into 4 categories. Heartland businesses offer high value creation potential and low value destruction risk, representing optimal corporate fit. Ballast units provide stable cash flow with low parent value add. Value traps destroy value despite opportunity because parent management styles mismatch. And alien territory units represent complete strategic mismatches that require immediate divestment. Corporate headquarters fulfills 4 value-creating roles: managing portfolio investments, managing linkages across units, managing individual business performance, and managing corporate change. Managing linkages often involves establishing shared services organizations. For example, Procter & Gamble's global business services centralized IT, HR, and financial processes across 7,000 employees in 6 global hubs, achieving scale economies and delivering over $800 million in cumulative corporate cost savings. How HQ controls business units reflects distinct managerial governance styles. Strategic planning style involves deep corporate participation in formulating unit strategies and decision processes, an input control approach used by Shell and IBM that maximizes synergy across related business units, but sacrifices unit autonomy. Conversely, financial control style grants units high operational autonomy while enforcing strict short-term ROI and profit targets. An output control approach used by Berkshire Hathaway that enforces accountability but risks short-term managerial myopia. Driving corporate transformation requires active change management. Jack Welch at General Electric introduced adaptive tension through workout meetings, eliminating bureaucracy and forcing internal units to respond to external market pressures. IBM developed the Emerging Business Opportunities process, establishing a structured incubation system that shields nascent ventures from conventional short-term financial ROI hurdles. Meanwhile, Samsung relies on top-down megaprojects, committing massive capital to drive technological leapfrogging across memory chips, displays, and mobile devices. To synthesize SMMC Lecture Note 10, successful product diversification requires passing Porter's attractiveness, cost of entry, and better-off tests. Ensure corporate HQ demonstrates clear parenting advantage. Capture economies of scope in the related diversification sweet spot. Balance portfolio matrices with Ashridge parent fit, and align control styles with business unit linkages. Thank you for watching SMMC LN10 with Professor Shihmin Lo. Stay strategic, and I will see you in the next lecture.